Coffee Talk session here today. As Jen mentioned, we're going to be discussing the impact of effective Treasury leadership on financial performance, which I think really hits on a key trend within the market today. And that's the evolving role of Treasury, and really this sort of notion that Treasury is becoming much less operational and much more strategic. And so during the course of this session, we're going to be discussing, is this reality, and to what degree does Treasury's role really translate into company performance? We're going to base this conversation largely around a study that Citi recently completed about the role of Treasury leadership within companies. It's entitled "Treasury Leadership Does It Matter?" So it's a really interesting piece, extensive research, a lot of good findings within here. We're actually going to drill into some of them directly during the course of today's coffee talk, and even show you some of the results directly here during the course of the session here today. But very, very happy to have one of the primary authors of that content piece here to support us in this conversation, Duncan, who looks after strategic partnerships for Citi in their Treasury and Trade Solutions Advisory Group. Duncan, maybe you could take a minute here and introduce yourself to the listeners.
Thanks, Jennifer. Thanks, Jonathan. Look, delighted to be with you here today. And I suppose just with that title, Treasury Leadership Does It Matter? Let me first off say, well, it does. So just to set people at ease, because I guess many of you coming in on the call here today will be from Treasury, so rest assured it does matter. So look, thanks, Sean. Yeah, my name is Duncan Cole. I'm based in Ireland. I say I'm part of the client advisory group with a focus now more on digitized advisory, actually taking advantage of some of the new opportunities coming about with the emerging and ever-emerging new opportunities from technology and to digitized Treasury, etc. Really utilizing data in a different way and trying to identify those value use cases to support the likes of AI that we're hearing a lot about today in the press, and the promise of that. So that's really what I'm about. I suppose if I may, Jonathan, just the team as well, just within Citi, I suppose our client advisory group that some of you tuning in today may be aware of, but we're a team of former Treasury practitioners that are really dotted around the globe to be close to our clients. So ranging from a colleague in Seattle all the way to another couple of colleagues in Shanghai. So we span across the globe to be close to our clients and to really hear the needs and wants and aspirations of our clients. And that's by design. And I say we're practitioner led, but we're really data enabled. And that kind of brings us to a second point. The data that we often use, and indeed the bulk of the data that we use to support this recent study that Jonathan was referencing there, was from our benchmarking of Treasury, which is acutely important because our clients at Citi, and indeed many of you in corporate Treasury, are very curious to understand what others are doing and how they're doing it and how they go about becoming leaders in their field. So understanding that and continually benchmarking our client sets, and we set what good looks like every year. Annually, we come together as a group across the globe, and we think about what we've learned in the last year and how that should reset the high bar for Treasury for the coming year forward, so that we can benchmark all of those that enjoy our service. So that's really a little bit about what we're about. I'm looking forward to this conversation today.
All right, thanks a lot, Duncan. Yeah, I think you guys hit the nail on the head with the research piece. It's really insightful, a lot of good, findings, I think, in there. And I agree with you 100%. Treasurers love to see data. They love to benchmark themselves against their peers and see what everybody else is doing in the market. And I think the research piece does exactly that. You alluded to this a little bit in the introduction already, but maybe you can start here by just sharing like the broad motivation for why you guys launched this study. Like, what were you really looking to get at? What kind of insights were you looking to draw out of it? And maybe even discuss a little bit the approach that you took in sort of collecting the feedback in this research piece.
Yeah, sure. Look, our clients, I'd say they're curious. But they're increasingly looking and seeking our insights as they shape the Treasury and they shape their investment roadmaps for the future. And they really want to do that in a targeted and a value-led way. So our motivation was really to help our clients build a case for change through that benchmarking tool, and to benchmark Treasury performance. And to do that, we wanted to see if we could identify correlations between Treasury leaders and indeed outcomes for corporates in the form of company performance metrics. That, thanks, Jen. Jen's showing a couple of charts there that we'll dip into in a minute. But I think, stepping back from a second, Jonathan, corporate Treasury, it's certainly going through a transformation, right? I mean, on the one hand, we've got, cost of capital, decades level high, and Treasury's pressed to efficiently fund the company, manage risk, and optimize the use of that capital, all with scarce resources in the organization to go about doing that. On the other hand, then Treasury also has to maneuver through the various disruptions that we see, be they, we don't have to look much further, difficulties in the Middle East, difficulties along many of the trading corridors, changing business models, emerging new technologies, supply chain shifts all the time. So all of these things disrupt how Treasury go about doing their business. And indeed, coupled with that, there's rising expectations from the CFO, the office of the CFO, to really drive Treasury and to provide that insights to the executive leadership of companies. So really, the Treasury role is, in many respects, under challenge to, yes, provide that risk management function across the organization, but also to support growth of the corporate business to ensure future. So building that case for change, budgets have always been a challenge for Treasury. They'll continue to be a challenge for Treasury. Access to technology resources will always be a challenge for Treasury to go about change. So how do clients go about building that case for change? And what our thinking was, well, if there is strong correlation in outcomes, company performance outcomes for those high-performing treasuries, that is not a bad start in making the pitch to the CFO for those scarce resources to drive transformation projects. And just looking at that, I mean, if we look at some of these charts, making that case for change, look at the top right-hand corner. I mentioned benchmarking a moment ago and how we're benchmarking Treasury, and we'll get into what that's about in a moment, perhaps, as to the various ways we go about doing that from a methodology perspective. But what that chart in the top right-hand corner is a summary view. We've pushed the corporate treasuries that have been involved, over 350 or just under 350 corporate treasuries, into their quartiles of performance. So the top 25%, the bottom 25%, and indeed the middle 50% of Treasury performance. And we've broken that into those quartiles through our benchmarking. We've taken the same companies and we've had a look at some of the returns metrics, publicly available information, annual returns, be it return on invested capital, return on assets, or return on equity. And you can see that there is strong correlation there. The higher performing companies have high performing treasuries. So you can see that there's a link, a strong link, and many would think it as maybe perhaps the missing link in providing that business case to the CFO. Similarly, if you look at the bottom left-hand corner, when we look at growth as opposed to returns, the growth of companies, when we look back a couple of years, again, looking at the top 25%, bottom 25%, and middle 50, you can see that growth for the top 25% is there. In fact, there's been a contraction in the bottom 25% of treasuries. There's been a contraction in the company growth for treasuries that have been underperforming against their peer. And then when we look forward, look at the median forecast earnings going out 2 years, again, we see that the higher performing treasuries have higher performing expectations around earnings growth looking out for the next 2 years. So really, it's strong evidence-based, Jonathan, and it underpins the importance of benchmarking Treasury. And by the way, this service that we provide at Citi is open to all of our Citi clients to see where they land in their Treasury performance. And should they be underperforming, that often builds a case just as much as if they're higher performing. And so I'll stop there, Jonathan. Back to you.
No, thanks. That was really helpful. And I mean, you guys have done a lot in terms of, I guess, confirming that Treasury leadership does in fact matter, but much more than that it correlates directly with company performance, which I think is really insightful. But maybe we could take a moment here just to sort of define what you mean by Treasury leadership. Are there certain areas that really stood up as best defining Treasury leadership in terms of the function that Treasury manages? Or maybe from the other direction, where there's certain functions that were kind of lagging a little bit behind the others and offering opportunities for improvements?
Yeah, no, absolutely, Jonathan. And I suppose, there are 6 pillars in how we measure it, first of all, right? Before we get into what's leading, what's lagging, what are we actually measuring? So if we look at the chart in the bottom right-hand corner, there's 6 pillars of how we view Treasury, all equally important. Each pillar there has underneath it in the benchmarking tool 30 or 40 questions, multiple choice questions, that our clients respond to that participate, right? So we go from policy and governance through liquidity, working capital, subsidiary funding, repatriation, risk management, systems technology. All of those pillars are measured through our benchmarking tool, and there is certain levels of performance. This is the aggregate result across the 350 odd companies, and we see that, to your question, John, I mean, the liquidity and working capital is where we see the most opportunity. So the scores there are the lowest for those two peers, which again is interesting in itself, because you think they would be table stakes for large corporates, but they show the most area for opportunity, and we'll drill through into that in a few minutes. And again, risk management, system technology underpinning the whole piece. There's opportunity there to improve. Okay, so they would be, I guess, Jonathan, the leaders, if you like, the leading areas of performance, and also the areas of most opportunity. And where we see most opportunity is actually in basic liquidity, risk management, and indeed managing working capital.
Interesting. Any insights into why that might be? Like, why sort of, I guess those are the areas where there's the most sort of catch up that Treasury can do, or at least the ability to really forward those topics to progress their position within the company.
Yeah, well, look, I mean, that's the detail of the study itself. So Jen, if you want to go on to the next page, we'll have a little look at some of these things. And this is a drill through into some of the data points for liquidity and working capital management. And in essence, we observe that the larger companies are displaying higher performance. Now, that doesn't mean that big is always better. What it means, though, is perhaps that the larger companies, they've been around longer, right? They're probably more mature. They have more time for their treasuries to mature, and also perhaps more time to invest in their treasury. Now, you could argue on the flip side, well, they may also have inherited much, a significant amount of legacy technology that would be a barrier to performance. But nonetheless, we're seeing that the larger companies are indeed, in general, performing better. Just as an aside to your question as well, Jonathan, I mean, the location of a company, where the geographical location of the headquarters, we see correlation in that in the study, and indeed the industry also shows some interesting correlations. Now, I should say, I know Jennifer's put up some links here in the tool, but there's a QR code there at the top right-hand corner of this page. So those that have a mobile phone to the ready, you can always hover over that and take a snap of the study itself. And if you do that, if you're very brave and do that, you'll see that, page 21, page 22 of the study brings you through the correlations by headquarters and indeed by industry. And perhaps no surprise to those that have tuned in, the treasuries in North America and EMEA are leading the treasuries in Asia and LATAM. And that's reasonably well recognized, but it's coming through also in our study. And we plotted that across a couple of axes in the study itself, both treasury sophistication and also the level of digitalization on the y-axis. And you'll see that in the study itself. And then from an industry perspective, interesting enough, the technology companies are lagging. You might expect that technology companies, the treasury of technology companies, would have lots of sophisticated automation coming to fore, and maybe better handle on data. That's not necessarily the case. It's a little bit like a dentist child often has bad teeth, right? So the companies that you think are highly sophisticated in their technologies have often not yet deployed those technologies inside the treasury organization of them. Power companies, chemical companies actually are leading. So it's some of the larger petrochemical companies actually have come through with higher sophistication. Consumer companies are up there as well. Healthcare companies are up there as well as high performing as an industry. Now, that view that's on the average, in the aggregate, whatever way you want to look at it. So it's a trend, right? You can of course have a high performing technology treasury, and you can of course have a low performing treasury in the consumer industry. But in the aggregate, that's what we're seeing in the study. If I look at this page that we're showing in front of you here, I'm drilling through into liquidity and working capital, just basic stuff really. The basic cash visibility on the top left-hand corner. To your question, Jonathan, what attributes make a leading treasury? Basic cash visibility. We do see certain improvements over time. If you've got good eyesight, the top left-hand corner, you'll see there has been some improvement in companies reporting greater than 75% visibility over their cash, going from 76 to 82%, 76% back in the 2019 and 2021 time, and 21 to 23 rising to 82%. So there has been certain improvement in basic cash visibility. Reasons for that we'll come into maybe in a few minutes' time. And similarly, that chart in the top left-hand corner breaks it out by company size. So generally, companies that are larger, greater than 10 billion in annual sales, are showing higher levels of visibility. And when we take it in the aggregate, going from 72% of companies less than 2 billion with greater than 75% visibility, rising to 82% of companies with annual sales greater than 10 billion with greater than 75% visibility. So there is a certain correlation there as well. When I look at the right-hand side, we talk about cash concentration. Cash concentration and the concentration of cash and risk in the Treasury is a basic building block, a basic fundamental of Treasury leadership. 78% of the 350 odd companies that were part of this study do indeed concentrate their cash either at global level or regional level. You might ask, 22% don't concentrate their cash. Why not? Great question. We should find out. But the point is that there is room for improvement. And again, you can see the difference by company size. When we look at annual sales, you can see that 83% of the companies concentrate their cash, the companies of size. Smaller sized companies, emerging companies, it falls down to about 42%, just over 40% of companies concentrate their cash. So room to improve. We understand that, we can explain that. I mean, many companies that are growing at that scale, they're more perhaps interested in increasing the sales, the collections of cash, as opposed to concentrating the cash and protecting those earnings through more robust risk management processes. So we see a shift, Jonathan, right, of risk management processes as companies scale. Looking at the bottom left-hand corner, in-house banking. In-house banking, there was that's probably the extension. The first step is concentrating your cash into a single legal entity. The next then is providing services through that in-house bank to the organization, be it payments support, be it settlement of intercompany loans, be it managing of banks, be it payments on behalf of all of these things that in-house banks typically provide. Interestingly, across the 350, only just over a third of companies have deployed an in-house bank. That was quite an interesting metric. We thought it was a lot higher. It does go up to 63% for companies with annual sales greater than 10 billion a year. And then finally on this page, just touching into working capital and the role of Treasury. When we did this, by the way, this is a biennial study that we do. So when I look back at the study back in 2015, 2018, and the numbers that were coming in, we could see that the role of Treasury was very much of an ad hoc advisory capacity. So there was no direct responsibility for Treasury to be concerned about the use of capital and to optimize working capital across and on behalf of the organization. That has changed, and we can see a transition point. That little crossover of those two lines there in the 2019 to 2023 study, you can see that there's now more treasuries, albeit only 42%, but there's more than 38%. So 42% of companies now have direct accountability and responsibility to manage working capital. So quite a shift, we believe, and that's driving some of the behaviors we're seeing in Treasury organizations. Look, I'll stop there for a moment and draw a breath, Jonathan.
I know that was a lot. I know there's a lot of results here to go through, but I think really interesting trends, particularly this working capital one, which I think is one you can feel in the market a little bit too, is that Treasury's playing a much more prominent role in managing working capital. And just curious if you have any insights into like why that might be. Is it like rising borrowing costs, no longer the availability of like this cheap capital? People are really thinking about optimizing working capital to improve free cash flow and really, sort of how Treasury can have more of a strategic impact from that front. Do you think that's mainly what's driving that, or you think there's a recognition of like Treasury's role kind of sitting in between a lot of these departments, sort of being like say a consumer of information from AP, from AR on a day-to-day basis anyway, for like projecting out cash flows and things like that, right? Maybe it's just a natural way for Treasury to fall in and be able to add more value to the business. I mean, maybe another thing that comes to mind is, the emergence of like, supply chain finance type programs as well, which a lot of companies have adopted over the course of the last, say, 3 to 5 years. And maybe, managing those programs out of Treasury is throwing the working capital area more into focus for them. But just curious if you guys are seeing anything at Citi that's really driving that trend, which seems to be sort of one of the key trends on this page here.
Yeah, no, it's all of that, Jonathan, right? I mean, certainly the rising interest rate environment is driving the cost of capital, and also the drive to use internal sources more than external sources of cash. So optimizing your working capital obviously drives down your overall interest charges, right? So it's very much in focus now. So companies are seeking a lot more insights over their working capital and advancing in the type of metrics that they use. So going beyond just the typical DPO and DSO, days sales outstanding, days payables outstanding, into some much more elaborate metrics to drive down the overall cost of capital in this rising interest rate environment. Now it is settling somewhat in certain countries and regions, but at the same time, it's certainly a lot more than it was in previous situations. I've heard certain number of clients tell us that they had got lazy in the lower interest rate environment, and they actually had taken their eye off, if you like, some of the efficiencies and some of the actions and activities that they needed to do to manage working capital efficiently. So I think that's being reversed now, and certainly we're seeing a lot more companies looking to have better connectivity into their ERP systems, have better oversight over their payables and receivables to really track where the problem areas are, be they individual suppliers, you say, and where they might need financing, either internally or externally, or indeed on the buy side. So there's plenty of activity, but I think all of the things you mentioned, Jonathan, are part and parcel of it. I think that the difference here, I think, is there's now a realization that Treasury has a significant role to play in managing the decision making around global supplier agreements, right? What currencies they're agreed to be in, how those, the terms of those global contracts, so that as those funds come through, they're in currencies that make sense, that can either be offset internally or they can be funded easily through surplus cash within the organization. So there's a I suppose a recognition that Treasury has to have a much more significant role to play, and how better than to make that role stick than to make Treasury accountable for the working capital optimization across the organization.
Yep. Agreed. Yep. So when I look at this, I mean, and obviously this is just scratching the surface on the results here, but you can really think of these as sort of like the leading practices of some of the sort of, I guess, top performing Treasury teams out there, right? So like, I guess if you're an end user of this data, you can kind of use this to understand where you sit in proximity to I guess the leading players and the leading individuals of leading Treasury teams in the market, right? So it's kind of clear, like the leading teams out there have greater than obviously 75% visibility over over their cash holdings, probably even higher than that in a lot of cases, right? They're thinking of like strategically about their cash management structures and how they're concentrating cash within the business. They have an active role in managing working capital, right? Is that the right way to think about this? Is that you can kind of like sort of use a lot of this survey results to really benchmark where you are and understand if you want to sort of move yourself into that top quartile of Treasury teams. These are some of the key areas that you should really focus on, sort of improving within the business.
No, absolutely right. I mean, when the individual client receives their benchmark study, they get a 60-page report, right, that goes through each of the 6 pillars of Treasury and scores their situation against various, I suppose, cohorts of clients that they wish to be measured against. So we often find that a company in a particular industry, in a particular geography, may not want to be the best in class and be measured even against that particular industry or geography. They want to be measured against another cohort of clients in a different industry or geography,
or indeed size to understand what better looks like than maybe best in class in their own particular, I suppose, family of clients. So, and each of that then drives certain findings and certain recommendations to go about instigating change. So if you think of it top to bottom, John, I think quite right. So you think, first off, yes, high performing treasury impacts company performance. Now, what do we need to do to become a high performing treasury? Well, these are the 10 things that I need to do based on my benchmarking against the 6 pillars of treasury. These are the things I need to focus in on that will provide the most difference, the most improvement for my organization, for my treasury. And it enables them to build a plan, if you like, a roadmap to achieve the type of objectives and aspirations that particular treasury may want to achieve. So you're thinking about quite. I mean, with giving TS inviting me in, I also put together a couple of pages on cash flow forecasting and how that looks. So Jen, if you want to go on to the next page, I'll show you what I mean. Thanks, Jennifer. So I suppose the first thing, and I have a couple of pages here in forecasting, but just if I may, Jonathan, I thought this might be useful to level set, because we often get asked the question, how should I think about cash flow forecasting? It's an age-old problem. I know TS providing solutions for it, but it's an age-old problem, and many clients struggle. And I think the first thing is top left-hand corner is, well, what are clients doing? And certainly there's 2 real purposes to forecasting cash, and I would like to think many on the call here today would realize. But first off, liquidity management, to short-term liquidity risk management, to understand your cash position, and secondly, then longer-term planning of your liquidity obligations and maybe currency risk management. So looking further out, and you can see that about 90%, and there's some variance in company size as to what's going on. The top left-hand corner just shows they're really the 2 purposes that are in play, and certainly 90% odd of companies are forecasting for cash management, liquidity risk management purposes, nearer term type objectives, and a slightly smaller number further out. The forecast horizon on the top right-hand corner plays out some of that metric as well, and you can see that almost, well, over 70% certainly are forecasting either out 6 months or 12-month time horizon. So that seems to be as far out as folks are going. Slightly smaller number going out monthly, and then weekly, daily, etc. So that time horizon, the most clients that are forecasting, they're looking out at least to a 6-month time horizon. Fixed versus rolling is a topic that often comes up as well, and we can see that again, about 76% of the larger companies have a rolling forecast in the near term, for the near term, and indeed medium term as well. Some of the smaller companies edging into the fixed term time horizon forecast as opposed to rolling. So rolling certainly seems to be the best in class approach. And then from a horizon perspective, on the bottom right hand corner, the frequency updates and how this is all working. And the update frequency for clients in the medium to long range again will be semi-annually from a range perspective, but updated monthly. Okay, so semi-annually updated monthly is probably the most normal of what's going on. And then in the nearer term, it's really a 30-day rolling forecast updated weekly is what we're seeing most clients actually operate. So when we get into forecasting discussions, clients wonder, well, what should I do? How far out should I look? How frequent should I do it? And why am I doing it? It just gives a sense of, well, when we look at 350 odd clients across the globe, what are they doing in average, and is that helpful in any way? Now, I would say that the first thing each client needs to do is to work out the why and what it is you're forecasting, and the purpose of that for yourselves, because the data and the data challenge underpinning the forecasting is significant. But certainly having a well thought through discussion in your own organization to understand how far out you need to go for what decision. Forecasting isn't for forecasting's sake, it's for a purpose. So what actions are you going to take on the back of your forecast? And if you just want the next slide there, Jennifer. The next slide touches in a little bit about the methodology that I spoke about a minute ago. And for many, and indeed still for many, manually forecasting using spreadsheet-based supports is there for a large number of corporates, despite the likes of TIS and other TMS providers providing forecasting solutions, connecting into your ERP systems to get hold of the payables receivables data automatically. There's still a huge number of clients who are using Excel either in full or in part to support their forecasting process. Now, the good news is that if we look at that dark blue line, if that's coming through okay for folks, you can see that the level of automation as companies grow in size is increasing significantly. So we think about companies less than 2 billion in size, just under a quarter of those companies have an automated feed from their ERP. When we move to companies greater than 10 billion in annual sales, that rises to just under two-thirds at 63%. So as companies grow and they see the need to move away from Excel and to create greater linkage with their underlying ERP system to support a better view of their future cash position and indeed their working capital, because of course the cash position, the future cash position, is based off the same data sets as the working capital insights that are gleaned from the payables and receivables. When we talk about a direct methodology being deployed, and you can see as companies grow, it's gone from just under a quarter to just under two-thirds of companies taking in automation. Historic pattern recognition is also one worth looking at. You can see the jump as clients get beyond the 2 to 10 billion range into the greater than 10 billion range. They are starting to look back more to look for those historic patterns, and this could be linked. Somebody might be linking that to the emergence of AI and the emergence of machine learning and better understanding of historic patterns to predict forward. And again, that's coming through the data that we're seeing in this study. Payment terms, using payment terms directly from the invoices is pretty flat, be it on a spreadsheet or be it coming through the ERP systems. Those payment terms is just under 50%, irrespective of company size. So methodology is a key thing to consider when you're bringing about your forecasting. And then variance, interesting with variance that about two-thirds, only about two-thirds of companies measure variance in the forecast, which is I suppose extraordinarily low. Given if you don't know how wrong it is, then it's most likely to be very wrong, and nor really know where the level of inaccuracy is coming from. So one-third of companies do not measure variance across 350 in this study. Those that do, you can see the spread of the level at which they're measuring variance, forecast variance, be it at business unit level or legal entity level, for the longer term and for the larger companies, right down to account level for some of the short-term financial forecasting in some of the smaller companies, where account level forecasting and variance analytics is more relevant. It's not relevant for the larger companies at all for them in the medium-term forecast. So I think that this, and I'm very interested to get your perspectives on this, Jonathan, as well, given the company you work for, if some of this resonates with you and is kind of what you're seeing as well as you tap into what typically are the same client base.
Yeah, no, I'd say we're seeing a lot of this as well. We tend to, I guess, serve some of the largest companies in the world. And, I guess a lot of them probably invested in technology a lot earlier than some of the smaller companies did, just because TMSs and Treasury technology just became sort of more affordable for some of the smaller companies, more easy to implement over time, where it was really sort of seen as a core value prop for the bigger companies right from the beginning. So I'm not surprised to see the sort of, I guess, the more sophistication in terms of the integration capabilities, like sort of more automated data coming from the TMS and the ERP, more use of things like pattern recognition, evaluating historical patterns, forecasting based on payment terms and things like that. I think we even saw on the previous slide that they're actually updating the near-term forecasts more frequently than the lower revenue companies, which is interesting too, because you would think on one hand, maybe there's less complexity on the low revenue side. Oh, that's a bit of a generalization. There's a lot of low revenue company or sub 2 billion revenue companies out there with a ton of complexity. But I think it's sort of, it speaks to the level of investment that they've done in the process to be able to see how they've been able to sort of, get to a more frequent update process, even in some cases a more granular variance analysis. Although you do see the most granular variance analysis being sort of completed on the sub 2 billion revenue range for clients as well. Driven, I think you called that one out nicely, probably driven by need to really understand things at that level versus sort of 10 billion plus, really needing to understand more business unit trends and maybe cash flow category trends and variances that are really existing within there. So, but definitely interesting stuff, I think, for sure, in terms of where companies are kind of sitting. And this one's an interesting one because I don't know, can you use this one as like a way to benchmark yourself, or is this more sort of like more of a trend? Because would you say that, hey, if I'm less than 2 billion in revenue, then best practice for me is to use Excel? I don't know if that's the case or not. Maybe for some companies it's it's sufficient, but yeah, it's an interesting one too to kind of take a look at, maybe a different perspective in terms of how to evaluate those trends.
Well, it comes back to returns on investment for the company. So if you're a company less than 2 billion in size, then indeed the right answer might be Excel.
Yeah.
I know that might be what some technology providers might want to hear, but until you reach a certain level of complexity and size, and have that fragmented ERP landscape that many of the smaller companies may not have, it is manageable. Now, whether it's the best answer, whether it positions the company for growth, when if the company has aspirations to get to the 2 to 10 billion size or beyond, then that's when the tipping point happens. And it's not just in this, Jonathan. It's also in risk management in general, across the study, where we see that as companies grow in size, there's a tipping point from really collections and collections optimization to a more robust risk management approach for the company to protect those earnings and to manage that cash and to manage working capital in a much more efficient and effective way. And to do that, of course, you need tools and solutions and better control over your data and auditability and traceability and all of that, which you can't get from a manual process on a spreadsheet. So I think there's that transition point, and that's certainly within our advisory group in Citi. A lot of the clients that approach us is at that point of transition from manual process, people-driven, people-led processes on spreadsheets, about at the point of purchasing a treasury management system, perhaps, and ready to really, I suppose digitize, as a term that we probably use too often, but you know what I mean, actually digitizing their treasury processes, so that they're getting away from paper, getting away from manual processes, and moving into a world of straight-through processing from ERP into treasury management system, and indeed deploying some of the niche players to support bespoke processes that they may need to support.
No.
So, okay. The next page, we want to keep going. I'm conscious of time, Duncan, so tell me when to stop.
Okay.
I think that I just gonna touch on this really quickly. I just thought it was interesting on the risk management side as well, and it kind of touches on what I was saying a minute ago, that there is this, there's room to improve across the piece. Top left-hand corner really is a measure of funding, and where clients needed to access sources of funding that were not planned for, so to access the unexpected. And even though, as was the top line there, where a company has a process in place to manage liquidity risk and to ensure they've got appropriate funding sources to support the various obligations that they have. And you can see a certain lineup from, based on size. But even though those processes are in place, almost 20% of those companies that had processes in place had to access an unexpected source of funding. So room for improvement in the basics there. And then on the right-hand side, here we're looking at interest rate risk management. And just for, it's worth pointing that 49% of companies are doing that on a monthly basis, managing interest risk on a monthly basis, looking at market rate changes or indeed other drivers to influence the interest rate risk. And on the right-hand corner is an interesting one. This is where we're seeing a break, if you like, between the objectives of Treasury managing currency risk and the practices that are in place. So, almost 2/3 of companies, or 64% of companies, report that they're looking to reduce earnings volatility as one of the key objectives in their risk management. But only 20% actually manage earnings translation exposure. So even though almost 2/3 of companies, their objective is to manage their currency exposure from an earnings translation perspective, they don't. Only 20% actually do. So there's a breach in I suppose the policies that are in place and the practices that are being deployed across risk management. And that's just one data point. And again, the study, for those that are interested, will go into a lot more. What might be worth doing, Jonathan, and I'm looking forward to maybe some questions from the audience, but the next couple of pages, technology is a key enabler for many of the companies that we spoke to, and the utilization of treasury management systems is at that pivot point that I mentioned a moment ago, where clients need to get off the manual process, spreadsheet type supports of risk management, or indeed collections processes, and onto a treasury management system. 63% of all 350 companies measured have deployed a TMS, which is, some might say, is quite low, because what that means is over 1/3 of those companies haven't got one. Now it does obviously change based on company size, but you can see there that 61% of companies, almost 2/3 of companies less than the 2 billion size, don't have a treasury management system. So a lot of investment to go, and hence those companies are the ones that need the business case to get the investment capital from the CFO to be able to purchase some of these technologies to support their processes, to automate their processes, to digitize the treasury activity, to be able to reach the levels of performance that others have, to help that company performance metrics kick in. Not much change over time either. When we looked at this between 2019 and 2023, not a whole lot of movement, irrespective of company size. Some of the smaller companies, small shift up, but not a whole lot of movement. Connectivity is probably even a worse problem, if you like, for companies. You can see that very few companies are completely integrated with their banking partners. So you have manual statements going across for a large number of companies, even companies greater than 10 billion in size. You can see that some of them still have manual connectivity, which is extraordinary in this day and age, given the majority of companies that come to us looking for advice. They're looking for advice in relation to when should they move to the API rails to support real time. In reality, there are many companies that are not anywhere near ready to have that conversation, and they're still manually gaining visibility over their bank statements into spreadsheets. So there's a lot of work still out there. And just to round it off, Jonathan, if you want to go to the next page, and just kind of my final chart to share with you guys. There are a large cohort of clients. So how do you understand this chart? So we look at it, there's really two axes on this chart. The x-axis is the level of sophistication. That's based on the benchmark results, and by quartile, as I shared a moment ago. In this particular chart, we're taking the bottom 50%, top 50%, just to draw a straight line to make it easier to see. So we've got low performing treasuries to high performing treasuries on the bottom, on the x-axis, and on the y-axis then we're looking at the level of digitalization. And what this is, we've in our study we take a subset of the questions asked to infer a level of digitization readiness and effectiveness, and when we bring that together we just call it more digitized. But what that really comes from is levels of STP, levels of connectivity, technologies deployed, level of automation that comes through the study, and that gives us a level of digitization. And you can see that there's obviously a correlation between the more sophisticated treasuries are more digitized, and that does make sense. What's interesting and intuitive, what's interesting as well is those that have declared treasury transformation programs underway more companies that are less sophisticated have declared treasury transformation programs underway. Which again, there's more work to do, so that's understandable. But the third observation here, which I think is probably important to understand, is the many projects, transformation projects we see, are failing through data challenges and data fracture issues and legacy technologies. And despite that, we see a very low number, or a relatively low number, of companies that have put a data strategy in place, or indeed put a digital strategy or have a digital officer in place. So those three measures, digital strategy, digital officer, and data strategy, we bring those together and use that as really the three I suppose attributes of a company that's ready to deploy and for success a treasury transformation program. But it's only the top sophisticated clients that have got a digital officer and digital strategy in place that have mobilized a treasury transformation, right? So that's why that little orange box is around that top right hand corner of that chart, and that's a concern. I think that's probably the root cause of many projects that have gone wrong, that have not realized the potential that had been thought at the outset, is because of the underlying data challenges and the lack of focus around understanding what needs to be done about the data first before you can deploy some of these transformational programs utilizing the emerging technologies. I think there's a key learning in here to try and leave you with, if I may, in that the underlying data story has to be resolved before mobilizing the treasury transformation objectives. Otherwise, there's a likelihood of failure that's we're seeing come through. Speaking with a large number of corporate clients at the moment. So, Jonathan, back to you. That's my final thought, which I hope resonates.
Yeah, no, I think that's a great final thought to end on. I think a lot of people maybe don't recognize that as much as they should, that, really getting that data strategy in place and that digitization strategy in place are key to using these technologies, and really, I think key to really putting in place, I guess the end state treasury objective for automation, even the level of analysis a lot of businesses want to get. You really have to have that data strategy solved for. So I think this is super clear, and I think it's a great visual representation that shows the convergence of all these different attributes on one graph here. I'd have to also think anybody going through a treasury transformation probably would love to take advantage of this benchmarking service to really understand where they should be trying to get to in comparison to their peers or others in the market, or really to help with alignment of objectives with actual sort of what they want to drive at for technology advancements. That seems like an invaluable tool, because I know a lot of treasury teams out there kick off a treasury transformation, but really haven't fully thought through what that means for the business and where they want to get to and what the end state objectives are for where they see themselves once they complete that process, or if it's a multi-phase process. So, a great report. I mean, yeah, obviously a ton of data here. I think we could spend endless amounts of time kind of digging into the results here, and definitely encourage everybody to check out the full report. Yeah, I think everybody will find the results to be really, really helpful in benchmarking. I know we have about 10 minutes here. We did want to reserve some time at the end of the session for any questions that might have come in from the audience. So maybe Jen, I don't know if any came in, maybe you could read a couple of the ones that came in from the audience out here.
Sure thing. Thank you so much, Duncan and Jonathan. Just as a quick note, we do have some content handouts that are available in the handout section in the control panel. So please feel free to download those. The first question comes in from Sarah. Is the pressure to reinvent the Treasury role primarily driven by internal factors, example, cost reduction, or external factors, example, regulatory changes? Would like to take that?
Yeah, sure. I'll first go with that. I suppose, look, the simple answer is both. I mean, there's pressure coming down on Treasury to be more efficient, to do more with less. We've heard that a number of times over the years, but I think it's never so more apparent now. And I think there's an expectation that with the onset of improved technology to deploy further automation in the Treasury, that more can be done with less people to drive efficiency into the organization, so that they can, a company can grow without having a a similar uptick in the cost of running the Treasury through hiring more individuals. So I don't see there being much of a contraction from a people perspective in Treasury, but I see the role extending in Treasury to go beyond risk management and fundamentals of Treasury to support company growth. So I think that the pressures are coming from the CFO, so those internal pressures. There's always regulatory pressure to ensure that the compliance and observance of the various regulatory controls that are across the planet, and they vary from country to country, and the different central banks and different regulations and all those things need to be adhered to. Cash concentration is a prime example of that. So the allowability of concentration of cash across the planet needs to be carefully monitored. Those regulations do change, and understanding what you can do and how you can go about doing it when you're concentrating your cash and risk is in itself a topic. So that's day-to-day BAU. There's nothing new in that. That's always been the case. So I think that regulatory pressure is always there to adhere to it. But I think what's new is the downward pressure from the CFO to deploy the emerging technologies, to optimize people's use of time, move away from manual tasks, move away from the repetitive activities. I mean, a great example of that, which is now, I believe, pretty much being resolved, the cash, reconciliation, circular reconciliation. There's, for clients that have invested in technology, there's no reason why that can't be fully automated as a process at this stage, and more will follow. So that strive to full automation is a journey that many are on, certain ambitions, but it will take time to get there.
Great, thank you so much, Duncan. The next question comes in from Nidal. Beyond foundational cash visibility, what advanced cash forecasting techniques are being used by the leading Treasury teams?
Great question. Do you want me to start that one, John, or do you want to have a go?
If you want to, I mean, you could start. I could probably finish that one up.
So look, well, first off, the move away from Excel, okay, and as you've seen in some of the charts, the level of integration with underlying data sources, be they ERP systems, be they liquidity planning systems, and depending on the forecast horizon, different sources of data are used. But that type of approach is certainly the first, I suppose, level of sophistication. When you go beyond that, and with the onset of new techniques, there's now a new frontier, for want of a better word, that clients can now strive for. And even before we mention the two-letter word AI, I mean, clients are considering things like commodity-based forecasting, which I think you and I, Jonathan, have spoken about a couple of times, where clients are looking to be able to if you like, model their business based on various underlying factors, macroeconomic factors, and indeed prices of the underlying raw materials that company consumes in doing whatever it does, right? So if a forecast was able to be adjusted based on those underlying drivers, that's certainly an area of interest that we've heard over the last year or more from a number of clients. The ability to have more effective stress testing. Many of our clients look at liquidity access plans and to stress test your liquidity access plan by adjusting some of those drivers of your forecast and not having to look at that from a bottom up all the way, but to be able to have the same mathematics supporting the forecast and then to be able to influence that forecast outcome by adjusting the underlying drivers of the forecast, and to be able to do that in real time. And I don't mean real-time information or real-time payments or real-time funding. I'm talking about real-time forecasting analysis, where you can adjust the underlying drivers and perform scenario analysis, stress testing of the forecast. That's really where the frontier is about. And the next level, I'll pass to Jonathan on this one. Jonathan, maybe over to you on AI, because I know you're thinking hard about that these days.
Yeah, and I think it's there's a couple of key trends I think we're seeing in forecasting right now. A lot of companies are thinking about the source data that they're using and the granularity of that source data as well, like those that are moving away from, say, more trend-based forecasts. Just because when you're forecasting based on real company information at a very, very granular level, the amount of analysis you're able to derive from that just jumps greatly. So like say doing a variance analysis at the end of a period of forecasting, if you use really granular sort of source data that ties back to your financials, when you do that variance analysis, you can pick up on key business trends for the why. And everybody knows, hey, cash was off this week. If it's trend based, it's because this week didn't look like the other weeks that we used to project this week. But if you use it based on actual financial data, you can pick out more, I guess, insightful type items like, hey, it's off because revenue was off, or it's off because our DSO jumped greatly, or there's some sort of business implication for why this happened. So I think that's something a lot of businesses are really trying to get to at the different durations, the short term, the medium term, and the long term forecast. And of course, like Duncan said, AI, I think everybody's seeing sort of the value in AI being that it can really help you see around corners, I guess. Most large corporates out there are digesting so much data in the creation of their cash forecasts. It's really difficult to pick out the key trends, the key insights, the things that could go wrong within your forecast that might drive a variance, say, at the end of the week, end of the month, and that might correspondingly change the way that you manage cash as a result. So I think companies are more and more using AI to pick up on that stuff, maybe like sort of payer level behavior type data, or other more obscure trends that might give the company good insights and put them in a better position to manage through some of those more unpredictable factors. But yeah, I think that's a lot of the key. There's a lot happening in the cash forecasting space, but I think that's a couple of the key trends that we're seeing.
Perfect. Thank you so much, John and Duncan. I think you basically already answered someone else's question about AI too. So thank you for also tackling that one. We probably only have time for 2 more questions. The next question comes in from Ezekiel. What is the replacement software for Excel and cash management?
Well, I can't let John answer that because he'll only give one answer, right? Which will be, yeah. So, but I think what our clients are doing, and look, many of our clients are doing this in Citi, where they're evaluating the alternatives. And I think that what I will say on that, and we're completely product agnostic at Citibank, so I'll say that up front. But I think what many of our clients are doing is they are evaluating the incumbent technology for many corporates, because our corporate clients talk to each other. So the likes of the ERP platform connected in with the treasury management systems, of which there's various flavors. There has been certain consolidation in the market, so there are leading TMS providers now, and I'd probably say there's half a dozen of those, 6 leading players, maybe 5 or 6 around the world, that you need to measure and see if the cultural fit is right for you and whatnot. But certainly to get off Excel, you're talking about a treasury management system. Now there's also niche companies, and the likes of TIS being one, that do support various processes. And I was talking to one of my TMS provider colleagues, just last week actually, and what she was underpinning, to my knowledge, is the modular nature of TMS provision right now. I think the kind of the multi-process provision that's unbundleable from a treasury management system provider, those days are gone, because of the way the services are constructed and delivered through the cloud. So it's almost all now software as a service delivered over cloud and in modular fashion. So the choice is there. So yeah, I'll stop there.
Okay, great. It looks like we are bumping up against time. So we did have a couple of questions that did not get answered. We'll reach out to you individually, and thank you so much for putting them in the Q&A box. John, I'll turn this back to you.
All right, thanks a lot, Jen. And thanks, Duncan, again, for joining today's Coffee Talk session. I thought it was super interesting. I know it's not easy to consolidate all those results that you guys have in that survey piece in just 1 hour, but I think you did a really good job honing in on a lot of the key trends there, the key takeaways that the listeners would love to hear about. So if anybody is, like I mentioned before, interested in reading the full report, I definitely recommend it. It's about, I think it's over 80 pages of research here. So if you like statistics, you like benchmarks and things like that, you're gonna love this report. It's all, really, really interesting stuff. I think that's super useful for the community. But thanks again, Duncan. Thanks for the listeners as well for listening, and hopefully you got some good insights there and some good ideas about how to drive the leadership role of Treasury within your own organization. And yeah, Duncan, thanks again. I appreciate you joining the Coffee Talk.
Pleasure. Thanks for inviting me.
If anybody's interested, Duncan and I are always happy to connect after the session here today. Either feel free to email us or reach out on LinkedIn. We're happy to continue the conversation if anybody heard anything that was interesting that we didn't cover during the course of today's session. But otherwise, we hope to see you on our next Coffee Talk. And thanks everybody for joining.